Okay, so I recently made a video discussing why Warren Buffett hasn't been buying stocks. The response from you was overwhelmingly positive, and yet the same comment did keep reappearing. Warren Buffett has lost touch with the market. He's 89 years old now, he's past his prime, and just look at his mistake selling airline shares. So, is it true? Is Warren Buffett out of touch in the modern day investing world? Let's talk about it. There's no denying that Warren Buffett has an incredible record over the course of his investing career. He bought Berkshire Hathaway in 1965 and has grown it to one of the world's largest companies, valued at roughly $440 billion, which gives him a net worth of around $70 billion. In fact, in 1965, if you'd invested $1,000 into the general American stock market, you'd now have a pretty impressive $200,000. But if you'd given the same $1,000 to Buffett by investing into his company, you'd now have an incredible $26.4 million, beating the stock market by 130 times. To add to this, we can see from this chart Buffett's company's average return per year versus the general stock market's return shown over the course of each decade since he began in the 1960s. Warren Buffett's performance is shown by this column. The general stock market is shown by this column. And how much Buffett's company has outperformed the market is shown by this column. As we can see, Buffett's return has been positive every decade, and he has consistently outperformed the market. However, it should be noted that this chart does only go up to 2014. We will be looking at the years after shortly. We can also see an interesting trend in that Buffett has outperformed the market less in recent decades. In the 1960s, 70s, and 80s, he gave investors a better return compared to the stock market of between 16 and 24% on average per year. Compare that with the 1990s, 2000s, and 2010 to 2014, and these numbers drop to outperforming the market by between just 2 and 7%. I mean, it's still pretty remarkable, but less so than his early years. In fact, let's look at Buffett's performance versus the market over the past 45 years. The line we can see plotted on this chart shows us Buffett versus the market. The higher the line, the better Buffett has performed. Well, as we can see, the line has been trending downwards with relative consistency since around 1981. In other words, Buffett has been beating the market less and less on average with each passing year. This chart is further evidence of the trend. As I mentioned, the first chart we looked at only ran until 2014, but this one covers the entire 2010s decade. And what we can see is that the red line, which represents the market, actually outperforms Warren Buffett over these years. So I want to jump in for a second and make something very clear. Buffett has consistently outperformed the market over a 55-year career and really only had a handful of bad years. When it comes to investing, that is pretty much unheard of. If Cristiano Ronaldo or LeBron James had a couple of bad years, they'd still be some of the all-time greats. So there's no question that Buffett is one of the greatest, if not the greatest investor of all time. That's why I look up to him, and with good reason. But the question we're asking today is Warren Buffett out of touch now? Has he lost touch with modern day investing? Well, it's fair to say that the past decade hasn't been the best for him. We can clearly see that his ability to beat the market has also been dropping year on year for the past 40 years since 1981. So why is this the case? Well, Buffett is famously a value investor. Value investing is an investing style which attempts to maximize returns by finding stocks that are undervalued. A value investor will use valuation methods such as a discounted cash flow analysis and compare that with the stock price to find companies that are trading below their intrinsic or fair value. So, in other words, value investors look at the market and they try to pick stocks which have a low price compared to the money that the company make. Now, this is an oversimplification, and I might go into more detail in the future video of what value investing is, but this description is good enough for this video to understand how Buffett is making his investing decisions. So, what's the problem with this? Well, as I often tell you, I'm just a regular guy researching the market to get my own head around things, and then I record these videos to share my research with you. So I'm really no expert, but this is my take on things. Since the 1960s, the stock market has become more and more efficient. And what this basically means is that people have access to information much more quickly and accurately than we've ever had in the past. I mean, we all kind of know this, right? We all carry around phones which have second-by-second updates, and we can invest from just about anywhere in the world as long as we have an internet connection. Because we all have such good access to information about stocks these days, it makes it very difficult to find a stock which people have simply overlooked. Now, don't get me wrong here. I'm not saying that stocks can't be misvalued by investors. Of course they can. The point is just that it's hard to find companies which other investors don't know much about. As a result, it's harder to find a hidden opportunity in today's market. Back in the 1960s and for decades after, good information was much harder and slower to access. As a result, if you did enough digging, you could find a big advantage over your fellow investors. This is where Buffett's value investing could excel the most. He could discover companies that other people had simply overlooked. As the markets have changed, Buffett has continued to stick with his investing philosophy. Now, to be clear, I'm not against value investing. I'm actually a big fan of it, but it is considerably harder in today's market than it was in years gone by. Also, managing an investment pot the size of Berkshire Hathaway's is in many ways much harder than managing a smaller investment pot. You see, only a few hundred American companies are actually big enough to be reasonable investments for Buffett. When you're investing into a company, you have to think of your exit strategy before you invest. Let's say a company has $10 million worth of trading volume per day. This isn't a problem for you or for me. We can easily cash out a few hundred or maybe a few $1,000s. But if you're Buffett and you're investing, say, $1 billion into the company, you probably don't have a viable exit strategy. As a result, you can't invest into the company. Instead, you have to wait until the company grows to a decent size, by which time a lot of the opportunity may have disappeared. As a result, Buffett's job gets harder in many ways as the investment pot grows. But we haven't talked about the biggest thing yet. I know you're waiting to hear this. It is, of course, Buffett not being keen on technology. Okay, so the first thing is that a lot of people say exactly that. They say Buffett isn't keen on technology. Well, from my research, that doesn't look like it's correct. As Buffett says, good investing is about exploiting one's area of competence. And he adds, there are all kinds of things I'm not competent to value. There are all kinds of things I don't know about, and that may be too bad. But why should I know all about them? So when it comes to technology, Buffett has famously stayed away more than other investors, not because he thinks it's bad, but because he simply doesn't understand it. And he makes the point that an investor doesn't need to understand everything. If he is very knowledgeable in a certain niche, then he can be very profitable within that niche, and he doesn't need to explore outside of it. However, the problem with this approach when it comes to technology is pretty evident as soon as we look at the largest companies in America. We have Microsoft, Apple, Amazon, Facebook, and Google, also known as Alphabet. Technology companies have come from pretty much nowhere to dominate the market in the space of 20 years. So while I generally agree with the principles that it can be valuable to specialize in a niche and ignore other sectors, you simply can't ignore technology. You can't ignore the fastest growing and most valuable sector in the world. Unfortunately for Buffett, this is exactly what he did for many years, with him ultimately admitting that he made a mistake. Part of Buffett's problem with technology, other than not understanding it, was because he believed that tech companies would always be spending money to have the most cutting-edge technology, which he thought wasn't necessarily a sustainable business, as anyone could come along and write software or design a chip that could topple a company. You see, Buffett has famously enjoyed investing into companies that have an ability to maintain a competitive advantage, or an economic moat as he calls it, which means that they have something, often a strong brand name that provides a lot of value as well as the product. Imagine, for example, that another company ripped off, say, Coca-Cola, and they took their recipe and produced the exact same drink, but under a different brand. Who do you think would sell more? Well, of course, it would be Coca-Cola by a huge margin. Why? Because Coca-Cola isn't just about the drink, it's not just about the recipe. It's about the brand name which goes with it. Buffett appeared to believe that technology was a constant fight to improve your tech, and whoever had the best tech would simply win. However, as we know, this isn't really true, as Apple and Amazon, for example, have evolved beyond just tech companies. They are firms with powerful brand names. This computer, for example, is a MacBook. I had a MacBook before this, and my next computer will probably be the same again. I just love the way that it works. Believe it or not, I'm actually still rocking the 2012 MacBook. Here, check this out. This is a thumbnail that I may be releasing sometime soon. Like I told you guys in other videos, I'm hoping to someday maybe achieve that crazy dream of financial freedom, which means I save up most of my money where I can. So using 8-year-old computers, for example. Oh, and before anyone comments saying that I'm an Apple fanboy, my phone, which is around here somewhere, is actually a Samsung. So figure that one out. But anyway, back to Warren Buffett, because this is interesting. Let's take a look at his current portfolio. As we can see, his biggest holding by some distance is in Apple, so he isn't avoiding technology anymore. However, as we scan down the list of companies, we can see that, other than Apple, his portfolio is very light when it comes to tech companies. Also, some investors don't believe that Buffett really views Apple as purely a tech company, with Chad Astman, the co-head of global asset management, saying that Buffett's investments into Apple is to gain ownership of the firm's ability to create brand value as a consumer goods company, and not necessarily for its ability to create groundbreaking technology. Apple's CEO, in fact, Tim Cook, agrees with this sentiment, saying he obviously views Apple as a consumer company. In other words, Buffett may recognize that Apple are a great company for selling products to consumers. The fact that the products they are selling are technology products probably isn't too relevant to him. Before we look at his recent sale of airline companies, I want to highlight the portfolio I just showed you of Buffett's was based on his most recent filing and some subsequent filings, meaning it might not be 100% up to date. This obviously doesn't change the overall point I'm making, but I did forget to highlight that point more clearly in the previous video I made on Buffett, so I want to be upfront about that. Anyway, let's look at airlines. So on May 2nd, we found out that Buffett had sold all of his airline shares. This included around a 10% stake in each of the 4 biggest US airlines: Delta, Southwest, American, and United Airlines. Since then, the price of airline shares have rebounded. At the time of recording, Delta Airlines is up 29% from $24.12, the day before Buffett sold. Southwest Airlines is up 28%. American Airlines is up 54%, and United Airlines is up 48%. Now, obviously, these prices could be slightly different depending when you're watching this, but whether it's Donald Trump or Dave Portnoy, people have been taking jabs at Buffett, and at this point, Buffett was wrong. The stock prices of all 4 companies are higher today than they were when he sold the shares, so it is just a fact that so far at this point in time, he has been wrong. But Buffett won't care about that. And no, it's not just because he's a multi-billionaire, it's because of how he views investments. As Buffett says, most of the professional investors focus on what the stock is likely to do in the next year or two, but they do not really think of themselves as owning a piece of a business. If you're making a good investment into a security, it shouldn't bother you if they close the stock market for 5 years. These words underpin Buffett's entire investing philosophy. He believes that investing is not a short-term game. It's a long-term commitment to a company. So he has been wrong on airlines so far, but it will be interesting to see how this plays out over the coming years. So we know that Buffett has an incredible record, and pretty much whatever happens must go down as one of the greatest, if not the greatest investor of all time. Yes, he has been somewhat lucky that he has had the American tailwind behind him for all of these years, but he's also outperformed the stock market by 130 times since he began in 1965. So he has had a lot more going for him than just luck. However, we also know that his investing performance has dropped in recent decades as he'd struggled to find an edge in the market. In my opinion, this comes down to value investors finding it more difficult to discover these hidden opportunities that Buffett used to find, and Buffett missing out on much of the growth of technology companies over the past couple of decades. So, has Buffett lost his touch? Is he out of touch with modern day investing? Well, I would say, and this is just my opinion after interpreting the data, that Buffett's general principles of value investing and buying stocks to hold them for the long term are some of the best strategies that any investor can use and will stand the test of time. But his willingness to overlook technology companies means he cannot be considered as the best investor over the past couple of decades, even if he is over the course of his whole career. What's really interesting for us is that we can still learn from Buffett. When we're considering our own investing, I believe that we can look at his general principles and try to apply something similar ourselves. We should ask ourselves, are we truly happy to hold this company for at least 5 to 10 years? If the answer is no, perhaps we should look elsewhere. When it comes to companies like Hertz and their bankrupt shares, obviously, nobody should be happy to hold them for years. So this tells us pretty clearly that we shouldn't be buying these shares. When it comes to airline companies, I honestly don't think I know enough to say either way, but I would ask you what you think. Are you happy to hold the shares for at least 5 years? The answer should give you an indication of what you think, and that could potentially guide your decision, whichever way that may be. So I recently put together a playlist breaking down what the world's billionaires are investing into right now. It's an opportunity for you to learn from the world's best investors. Click up here now to check it out, and thank you for watching.